Index funds, mutual funds, hedge funds, ETFs. You've probably heard these terms thrown around all over the internet, but do you actually know what they mean? In this video, we're breaking them all down in the simplest way possible. You'll see exactly how they work, how they're managed, their strategies, risks, and fees, and most importantly, which ones actually make sense for you. Give me minutes, and you'll walk away understanding concepts most people never take the time to figure out. Quick reminder before we get started, this is not financial advice. What is a fund? Before we dive into the different types, let's first get clear on one thing. What is a fund, really? Picture this, you and a group of friends want to throw a massive party. Instead of one person footing the entire bill, everyone chips in some cash. That way, you can get all the good stuff, decorations, food, drinks, music, without one person carrying all the stress or cost. That's exactly how a fund works. Investors pool their money together, and that combined cash is spread across a bunch of investments, stocks, bonds, real estate, or other assets. You don't have to manage each piece yourself, the fund does that for you. You simply invest and share in the overall returns. Index funds. Now let's start with one of the most popular types you've heard about online, index funds. You've probably seen creators say, just put your money in an index fund and relax. But what exactly is that? An index fund doesn't try to pick winning stocks. Instead, it mirrors a specific index, basically a list of companies designed to represent a slice of the stock market. Think of an index as a scoreboard for the market. Take the S/&P 500, it tracks 500 of the biggest companies in the United States. Larger companies carry more weight in this list, meaning they influence how it moves. When the S/&P 500 goes up, it usually reflects the market's overall performance. Other examples. Nasdaq tracks big tech names like Apple, Amazon, and Microsoft. Dow Jones, a list of 30 big US companies across multiple industries. There are indexes for international markets, small companies, or specific sectors like energy. Index funds are passively managed, meaning nobody's constantly making buying or selling decisions. The fund just follows the index. This makes fees super low. Typical expense ratios are between 0.02% and 0.2%. That's $0.20 to $2 a year on every $1000 you invest, basically nothing. Big providers? Vanguard, Fidelity, and BlackRock's iShares are the leaders. Index funds are also low risk compared to picking single stocks because your money is spread across hundreds of companies. One thing to know, you can't trade index funds instantly. Their price is updated once a day after the market closes. That's called the net asset value, NAV. So, if you buy at noon, it processes at that day's closing price. For long-term investors, this isn't a big deal. That's why index funds are often recommended as the simplest, most reliable way to invest. Mutual funds. Mutual funds might look similar to index funds because both pool money and invest it across different assets. But here's the key difference, most mutual funds are actively managed. That means a professional or a whole team is making decisions on what to buy or sell, aiming to beat the market. This sounds great in theory, but there's a catch, higher fees. Mutual funds often charge 0.5% to 1.5% annually, sometimes even more. And studies show most managers don't consistently outperform index funds over time. So why do people still choose mutual funds? They trust a particular manager's strategy. They want access to specialized sectors or global markets. Or they prefer someone else actively managing everything for them. Like index funds, mutual funds are priced once per day after the market closes at their NAV. Companies like Vanguard, Fidelity, and JP Morgan offer tons of mutual fund options, both active and passive. Hedge funds. Now this is where things get intense. Hedge funds operate in a completely different league. Despite the name, which comes from hedging risk, these funds are often about taking huge risks for huge rewards. A hedge fund is a private pool of money from wealthy individuals and institutions. They use advanced strategies to try and generate big profits, like short selling, betting a stock will go down. Leverage, borrowing money to invest even more. Derivatives, complex financial contracts. Managers of hedge funds have far more freedom than mutual fund managers. This means they can make bold, aggressive moves, but it also means they can lose big. Because of their risk, hedge funds are only open to accredited investors, people with very high net worth or income. Their fees are also famous, the 2 and 20 model. Investors pay 2% a year just to be in the fund, plus 20% of the profits. Hedge funds aren't for the average investor. They're high stakes, high reward, high risk, ETFs, exchange-traded funds. Finally, let's talk about ETFs. Think of ETFs as the best of both worlds between index funds and stocks. Like index funds, ETFs hold a basket of investments, but here's the difference: ETFs trade on the stock market all day, just like individual stocks. That means you can buy or sell them instantly at market prices, which makes them a favorite for both casual investors and active traders. Most ETFs are cheap, with expense ratios between 0.03% and 0.75%. They often track indexes passively, so their performance is tied to the index they follow. ETFs exist for everything. The S&P 500. Technology stocks. Bonds. Commodities like gold. Even cryptocurrency. Many brokers also let you trade ETFs commission-free, making them easy and affordable to use. Conclusion. For most people, the smart choice is index funds or ETFs. They're straightforward, inexpensive, and provide wide diversification, which makes them perfect for long-term investing. Mutual funds can make sense if you trust a specific manager's vision or want exposure to certain markets, but be prepared for higher costs and no guarantees of better returns. And hedge funds? Those are for the ultra-wealthy risk-takers who don't mind massive fees for the chance at massive gains. Now that you know the differences, you can decide which strategy actually fits your goals. If you found this breakdown useful, give this video a like, subscribe for more content, and check out another video I've linked right here. Thanks for watching, and I'll catch you in the next one.